Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good morning. It's Tuesday, September 16th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So the ETFs, they jump back into that silver market, adding about 6.76 million ounces in their holdings here from the previous trading session on Monday. This comes on the heels of Friday's massive liquidation where they had profit take place on Friday after that surge up to about 43. But the investors, they re-entered the market on Monday, perhaps trying to avoid some kind of Sunday bull trap. A lot of times over the weekend, we'll see broad-based liquidation in certain asset classes like we've seen recently, where in the crypto market most recently, you get the Bitcoin futures, you get XRP, you get Ethereum all closing near those highs with the Friday futures close, and then over the weekend it's a steady broad-based liquidation that seems to accelerate with gaps on Sunday. Now we've seen some degree of different news flows that have occurred, and a lot of people were concerned that Trump would announce new tariffs or he was trying to plan one against Russia in a coordinated effort with NATO and NATO allies here as far as those oil exports here, trying to cripple Russia's economy. So this weekend we saw a lot of people taking some profits, reducing into the weekend here because of that heightened uncertainty. And now that big step back into the market here on Monday. So you got December silver firmly over that $43 at $43.16 with a narrower trading range of about 40 cents overnight. Remember, historically, when you went back to 2011, I told you that we broke through that 43 level, and then we got that on a decisive closing basis, and the futures now were trapped within a new about $2 range from 42 to 44. So has the retail investor figured out silver's bull trap, at least over the weekend, when they are unable to exit those markets here? Nobody knows here, but it looks like there was some degree of pre-positioning taking place here with that Friday close and the re-enter here on Monday. You look at the gold market, well, gold futures advancing 40% this year, with futures hitting a fresh record high, 37.3710, trading about $3 just below that, up under just about 0.5% as of this recording, and they were up about 1% yesterday. We got the NASDAQ futures here continuing to tack on some gains, having 10 straight days of gains here in one of the longest stretches that I've seen in quite a long time. And this comes right ahead of that Federal Reserve as they prepare to launch that new interest rate cutting cycle. So the question is, will it be 25 basis points? Will it be 50 basis points? In my opinion, I don't really want to see a 50 basis point, because you look at some of the analysis, and JP Morgan puts out a fantastic report here as far as some volatility expectations that take place under certain different scenarios. Like, what if the Fed hikes rates for some reason? Well, we could see a massive decline, 4 or 5% on something like that. If the Fed they take a pause, we should see a pullback of about 2%. If you look at a hawkish 25 basis point cut, that's more like the, hey, it's one and done, we're going to stay data dependent, we want to see how this inflation plays out. We're still tacking on that uncertainty surrounding Trump and possible tariffs having a ripple effect on the economy. And we believe that the labor market, hey, some of that recent data was more of a one-off type event here because of some flooding that took place in Texas. Then you should see some kind of conditional sell-off in that market to slightly lower here. So you look at a lot of these different scenarios here. What I believe the most likely scenario will be is that the Fed does cut rates 25 basis points, leaves it with a slightly dovish tilt here. However, does try and maintain that data dependency as they firmly believe that they are justified in having. And the fact is we get a little bit of volatility in the market. If you do get the 50 basis point cut, the problem is that historically, every time we've seen that type of action take place, it's been a precursor to a recession, and recessionary fears and recessions coming back would not play out well, in my opinion, in the U.S. equity markets, would not play out well in industrial metals, things like silver, things like copper. So you really don't want to see that 50 basis point cut, in my opinion. So let's check out the setup in the precious metals, the U.S. equity markets. Well, the futures, they're rising with global stocks continuing to hit all-time highs here. Asset managers are becoming increasingly bullish. And what we saw was when we came out of that April sell-off and in May, we got that gap higher. A lot of people working closely with me, positioned on the long side of things like the NASDAQ, things like the S&P 500 in conjunction with their precious metals holdings. And what they saw was a continued flow of CTAs trying to gravitate towards the bullish side. Now those CTAs in certain areas seem to be stretched here in pockets of the market, with some funds already at their maximum long in positions, leaving the market slightly vulnerable as dealers would have to come in and short futures on any kind of breakdown in order to hedge some of their exposure on the options front. So you look at the S&P 500 up about 0.2%. Remember, December is your front month basis, trading at 66.91.5, and you look at that September 66.33. You don't want to be involved with the September contract anymore. You want to roll over to the December because that's where the volume is at. And as long as there's volume, as long as there's open interest, then stop loss, then slippage and things like that become very narrow as you get tighter bids and offers. You look at the NASDAQ up about 0.4% here, and you look at the global markets. You go to European trading, well, those stocks they were steady here today. Investors turned a bit cautious ahead of the Federal Reserve's meeting here. In Asian trading, Asian stocks, they continued to surge to fresh intraday record here, and the MSCI tacked on about 0.8% to its highest level on record here, with chip stocks such as Taiwan Semiconductor and Samsung Electronics really leading the gains. You look at the copper market, that's been pushing up higher here, and it's taking a breather here this morning, down about 0.2% here after reaching the highest level since July 30th. So your key level of support on the copper market that I outlined in the chart pack here, and we drew a trend line that has held ever so nicely, and that breakout here that we saw yesterday to the upside above this key level that we flagged here that said would bring those traders back into the markets. Now that old resistance point should become a new area of pocket support. So right around that 463 area, where a break below that could cause a retest down to about 445. So that's really some of the risk management that I'll be using with some of the clients that are positioned in the copper market. You look at gold futures after about 4 or 5 days of consolidation between 3650 and 3700, finally breaking out to the upside. The silver market also breaking out, but that broke out prior to the gold market on Friday with Monday's extension. So I would look at that 4240 area as kind of your key level of support. Below that would be 4125 down to 4115, and a washout below that would retest most likely that $40 scenario. You look at the platinum market, it continues to wind up here with a sloping downward trend line here that could act as some small resistance. And then you look at some other markets like Bitcoin consolidating right near that 116 mark, which has been our pivot point here that I've mapped out for 3-4 months now. Between that June and the August highs has really been kind of your parallel channel going back and forth. You go to the CME's Fed Watch tool, 96.1% chance that the Fed cuts 25 basis points, about a 3.9% chance that the Fed cuts 50. I've told you for the last few weeks that 50 basis point interest rate hike, those expectations are going to slowly slide away as we get into that meeting, and that's what we're seeing right now. In the poly market, it's a 91% chance at 25 basis points, 7% chance of a 50. We'll have retail sales, we'll have import-export prices. These are very important components because they could give us some kind of clues as far as how as forward-looking interest rate cuts could play out. We'll also want to watch industrial production and capacity utilization. You look at some things here in the ETF flows. Again, gold up 14% as far as percentage change on the ETF flows. The exchange traded funds, they added about 130,000 troy ounces of holdings in that previous session. And again, to wrap up on silver one more time, they added 6.76 million troy ounces. So if you want to open up a trading account with Blue Line Futures, send an email to info@bluelinefutures.com. If you want to check out some of our research, we've got a lot of great products that we put out here. I put out daily intraday support and resistance levels that someone could use for tactical entries and exits on the markets. I tend to use those more when the market is either in a phase transition where something might be going from bullish to now bearish or bearish to bullish, and you want to use more volatility adjusted ranges for re-entering or lightening up on your positions in those markets. So we'll see what happens and how things play out. We still have a full day here before that Fed meeting, so expect to see some adjustments take place, but really pushing past the Fed meeting, you'll have that Friday expiration of the options, and it's one of the largest ones on record here, with the dealers really having quite a bit of short calls that I'm seeing here, that they might need to push this market down a bit to reposition if they haven't done so already. So remember, futures and options trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck and good trading.